As an employee, we've all experienced the thrill of payday, that exhilarating moment when you see the fruits of your labor reflected in your bank balance. It's a tangible reward for the time and effort you've invested in your job. But have you ever thought that there's a parallel financial joy for those who've mastered the art of dividend investing? That's right, just like payday, dividend day can be the highlight of their financial calendar. There are two distinct categories of individuals: those whose livelihood depends solely on their salary, and their income is intrinsically tied to their active participation in the workforce. They rely on a linear income stream that ceases the moment they stop working. You can say it as active income. On the other hand, a different group thrives on dividends, whose income originates from dividends, expanding significantly through the potent force of compounding, in contrast to salaries. The fruits of an ever-growing income source that thrives even if they stop working. As a result, the wealthy continue to amass wealth, while the less fortunate remain in their existing circumstances. Warren Buffett, a master of strategic financial approaches, has adeptly harnessed the potential of dividend investing to his advantage that has helped him become the fifth richest person in the world. Many people are interested in dividend investing as a top choice for making money without actively working, and there are several good reasons for that. One of the reasons of dividend investing is that you don't necessarily need a huge capital to start, and you can start with a relatively small amount of capital. Unlike some other investment strategies that might require substantial initial investments, dividend investing can be accessible to a wide range of individuals with varying budget sizes. It has the potential to contribute to significant wealth accumulation over time, through the power of compounding. Warren Buffett holds multiple stocks in his Berkshire Hathaway portfolio that pay out dividends. Over half of Berkshire's holdings pay a dividend, and several of them have yields near 4% or higher. Buffett doesn't like to pay dividends, but he loves receiving them. Let's see, what does Warren Buffett say about dividends?
Well, the answer is I do believe in dividends in a great many situations, including many of the ones companies in which we own stock.
In the context of the stock market as a whole, stocks of companies are generally subcategorized into various different types. One such categorization is based on the kind of value that the stocks offer to the investors. According to this kind of categorization, stocks can be broadly split into two types: growth stocks and dividend stocks. Whenever a public company earns a profit and has excess funds, the management generally has three main options to consider: stock buybacks, reinvestment, and dividends. In the stock market, we can potentially generate earnings not through just one avenue, but through two distinct ways. The first way involves selling the stock at a higher price than you bought it. The second way involves receiving a portion of the company's profits as a dividend payment. Open your web browser and go to the FinViz website. On the FinViz homepage, locate the Screener tab in the top menu and click on it. Once you're on the Screener page, you'll see a variety of filtering options to narrow down your search. Under the Descriptive section, find the Index filter. Select S&P 500 from the drop-down menu. This will ensure that your search is focused on stocks within the S&P 500 index. Set a minimum dividend yield value that you're interested in. We'll select positive. You'll see a table displaying the stock symbols, company names, sector, and other relevant information. To review the list of stocks that meets your criteria, you can click on individual stock symbols to access more detailed information about each company, including financial data, charts, and news. We'll select Apple. You can see the annual dividend yield of Apple is 0.56%, and the annual dividend amount of Apple is 96 cents. The dividend payout ratio of 14.72% indicates that Apple is distributing 14.72% of its earnings as dividends to its shareholders. This ratio represents the portion of the company's earnings that is returned to investors in the form of dividends, with the remaining percentage being retained by the company for various purposes, such as reinvestment, expansion, or other financial activities. Ideally, you should look for companies with a dividend payout ratio of less than 0.6 or 60%. When a business pays out 60% or less of its net income to investors, it means it will have 40% or more of its earnings left over to fund its own growth and expansion. Moreover, you can invest in exchange-traded funds. ETFs are investment funds that consist of a collection or basket of stocks, bonds, commodities, or other assets. These assets are bundled together and sold as shares on stock exchanges or traded as a single unit on stock exchanges. ETFs are designed to track the performance of an underlying index, sector, or asset class. It's a convenient way for investors to gain exposure to a diversified portfolio of assets without having to buy each asset individually. The dividend yield, expressed as a percentage, is the amount of money a company pays shareholders for owning a share of its stock divided by its current stock price. To calculate dividend yield, all you have to do is divide the annual dividends paid per share by the price per share. For example, if a company paid out around $4 in dividends per share and its shares currently cost $100, its dividend yield would be 4%. Dividends are typically paid on a quarterly basis, and mature companies are the most likely to pay dividends. You might assume that the optimal strategy is to identify stocks with the highest dividend yields, but in reality, that might not be the most advisable approach. The dividend yield may help investors decide whether a company's stock can be a good addition to their portfolios. They should remember that higher dividend yields do not always mean good investment opportunities. A high dividend yield may result from a declining stock price. These companies may be undervalued or could be facing some business challenges that have depressed their stock price and pushed the dividend yield higher. Just because a company is producing dividends doesn't always make it a safe bet. Management can use the dividend to placate frustrated investors when the stock isn't moving. In fact, many companies have been known to do this. Therefore, to avoid dividend traps, it's always important to at least consider how management is using the dividend in its corporate strategy. One of Warren Buffett's well-known examples of using dividends to build wealth is his investment in the Coca-Cola Company. In 1988, Berkshire Hathaway, Buffett's investment company, acquired a significant stake in Coca-Cola. This investment has become a classic case study in the power of dividends and long-term investing. Berkshire continues to collect dividends from the investment, and the amount might surprise you. Coca-Cola paid 4 quarterly dividends, totaling $1.76 per share in 2022. Berkshire held 400 million shares of Coca-Cola in 2022, allowing it to earn $704 million in dividends from the company. Buffett first started buying shares of Coca-Cola in 1988, not long after the famous Black Monday stock market crash in 1987. By the end of 1989, it purchased 23.35 million shares, worth $1.8 billion. Since the end of 1988, Coke stock has climbed 1,750%. Buffett has rarely transacted in Coke stocks since 1989. He added to Berkshire's holdings in Coca-Cola in 1994, bringing its ownership to 100 million shares at the time, but Buffett has never sold a single share. The stock has split 2 times since 1994, bringing Berkshire's ownership to 400 million shares. At the current stock price of $56.74 per share, Berkshire's investment in Coke is worth $22.6 billion. That leaves an unrealized gain of $21.3 billion on the investment. The gains are even larger when factoring in dividends. Coca-Cola has maintained a 60-year streak of payout hikes, making it a dividend king. Hence, those 35 years of payouts have earned Berkshire nearly $10.2 billion in dividend income from this stock. Here's how the strategy worked. By investing in high-growth stocks at a young age, you have the advantage of time, allowing your investments to compound over the long term. Compounding means that your initial investments, along with the reinvested dividends, have the potential to generate substantial returns over time. While high-growth stocks might not initially pay dividends as the companies mature, and when you are in your 30s or 40s, they might transition into dividend-paying entities. This means that the dividend income you receive could grow over time, providing a reliable source of income in the future. Investing in companies during their growth stage allows you to enter at a relatively low cost compared to established giants. If the company successfully transitions to a more mature stage, the value of your initial investment can increase substantially. However, investing in companies at the growth stage can indeed be risky. One of the advantages of dividend investing is that you can start with a relatively small investment. You do not need a lot of money to start dividend investing. Beginning with a small investment encourages financial discipline and the habit of regular investing. Consistently contributing to your investments, even in small amounts, can lead to better financial habits. It mitigates the potential downside risk. While all investments carry some level of risk, beginning with a small sum allows you to test your investment strategies and gain experience without putting a significant portion of your savings at risk. Dividend-focused portfolios often contain a mix of industries and sectors, providing diversification and reducing risk. When investing in real estate, your capital might be limited to purchasing a single property, whereas with stocks, the same amount can be diversified across various companies, enhancing your portfolio's risk management and potential for returns. Companies might cut or suspend dividends during economic downturns or financial challenges, affecting the investor's expected income. Sometimes a company will reduce its dividend because it changes its capital allocation policy. A company may believe it has better uses of cash than to pay a dividend to shareholders. Instead, the company may invest more in the growth of the business, fund an acquisition, pay down debt, or repurchase shares. Dividend income is often subject to taxes, which can reduce the net returns for investors. The way dividend stocks are taxed will depend on the type of account you hold them in. If you hold the stocks or dividend-paying funds in an individual or joint account, you'll pay taxes on the dividends you receive as well as on any realized gains. The rate on capital gains will depend on how long you've held the asset and your income level. If you hold dividend stocks or funds in tax-advantaged accounts, such as a traditional or Roth IRA, you won't pay any taxes on the dividends or your realized gains. Companies that prioritize dividend payments might allocate less capital for growth opportunities, potentially limiting the stock's price appreciation. They may struggle in saturated markets, be more susceptible to economic downturns, and could be less appealing to young investors seeking higher returns.